Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for April 19th of 2021. Please see our disclaimer for important information. Well, in our weekly COVID tracker, we continue to monitor the progress on a 7-day moving average of our new positives as well as the trend in deaths, which, as you can see here, continues to move down as we get more people vaccinated. Very positive trend. We have seen an uptick, interestingly enough, in the daily new positives, which, as you've been watching these things for several weeks now on our charts of the week, you'll note that we've been in an uptrend for several weeks, but it's a modest uptrend. And again, the hope is that we get a little bit closer to herd immunity and we make more progress in terms of the vaccine rollout, which even despite the pause in the dispensing of the Johnson & Johnson vaccine, we're still vaccinating a lot of folks. In fact, the daily average nationwide, I believe, has moved up closer to 3 million doses a week, whereas just a couple of weeks ago, that was only 2 million. So I feel at some point we're going to see a meaningful attenuation in this modest uptick in daily new positives. Here's a chart from the CDC. We've shown this before, but I thought it'd be interesting to update. So this is an overlay, if you will, of the share of COVID-19 deaths, which kind of breaks it up by age cohort. And we know, and we've been following this for a long time now, that obviously the more at-risk population age groups, as you get above 50 years of age, are certainly and indeed the most vulnerable, and those, as you might imagine, represent a disproportionate amount of the deaths that have occurred. Now, if you look at the overlay, which is the blue here, and this is the share of the population with at least one vaccination dose. Again, some of these people aren't necessarily fully vaccinated with the double dose for Moderna or Pfizer, but they at least have one. And you can see that by and large, we've done a pretty good job with the older age cohorts. And so I feel good about those trends. Here's a trend in by country of vaccine doses administered. We've been talking a lot lately about the US, UK, Israel. There's a small cadre of countries that have really kind of gotten out in front of this and done a good job with it. Now, there are other countries that have lagged behind, including, I will say, certainly, Europe has really struggled with a vaccine rollout. But you can see here that the trend across the board is mostly positive, with some notable kind of exceptions. But by and large, the trend is positive, and this is good for a lot of different reasons. Obviously, inter country commerce, travel, and leisure, and the increase in mobility across country borders and things like that. So we'll continue to monitor this and maybe update this chart here in a little bit. Here's our high frequency data. We continue to monitor, again, positive trend, maybe a little bit of a slight step back in the open table numbers as well as the TSA checkpoint data. Again, nothing that gets us really concerned because the month over month numbers are extremely high as we see both on the hospitality side, TSA checkpoint, table, miles traveled, gasoline purchases. I mean, all of that data looks really, really good. Even the box office receipt numbers are trending much higher as we're getting more releases in theaters and more of a reason for people to get out and go enjoy leisure activities. Here's a quick slide on change in transit ridership, and this data comes to us from several different metropolitan transit authorities. You can see here Chicago, LA, New York, and the Boston area. And what you see here is actually very consistent, and there are some really good read-throughs here. You can see a kind of obviously the consistent decline as transit systems and economies were shut down, but then the slow trend upwards to kind of battle back, and there was a leveling off in the second half of last year. But we've seen kind of a noticeable uptick in the 2021 year to date. and especially in LA County, which is really encouraging because California, as we all know, has been a state that has been shut down for longer and more deeply than other regions of the state. But again, good read through. We're getting more ridership. That means more mobility and ultimately more commerce in some of the more impacted service industries, et cetera. This is a quick chart on the TSA checkpoints, and so it kind of brings us up to speed. And we've shown this before here in Charts of the Week, not too many weeks ago, but it kind of brings us up to date. And you can see the difference in where we are relative to 2019 and 2020, in which we had the big drop, but we're well above where we were. And we came through the end of the year with a little bit of a dip as we had kind of this offset of holiday travel coupled with a pickup in coronavirus cases and some renewed restrictions and things like that. But by and large, getting past January, the numbers really have looked good, even though we're far below where we were just a couple of years ago. Now, as we transition into some of the more economic data points, this one I want to show you from Oxford Economics is real GDP growth. And so, you've got two things here. You've got the green line, which represents year over year, and then you've got the quarter to quarter annualized data. And as we've been talking about for the last several weeks, we're expecting a very big number for first quarter. In fact, it could be some of the strongest growth, frankly, that we've seen in decades. And a lot of it comes from, personal spending, which we've got some charts on that. We've got, on the consumer side, we know that industrial production has been up, even with the kind of the supply chain choke points, if you will. But we're expecting a really, really good number for this first quarter, and we'll get that fairly soon here. It usually comes at about a 3-week lag, at least the first reading of the first quarter economic number, which we'll be able to talk about in a little bit more detail in a few weeks on this same Charts of the Week broadcast here. But and you can see the year over year is looking better. Now, we have these what we call kind of base effects. So we're looking better year over year. Granted that last year was a tremendous dislocation, but the takeaway here is in that red bar, and that we're expecting a very strong first quarter economic growth estimate. Here's a quick look at Beige Book. This is a Federal Reserve Board. It compiles over their districts economic data, and these are sentiment indicators from businesses, sentiment indicators from manufacturers and service companies, et cetera. And you can see here on the left that number has picked up. And that data point, that last data point there that we see kind of encircled in blue, it really represents a nice uptick from where we had been, frankly, over the last several years. So this is an index, and what I can tell you is that that this is very positive. We know that the economy is beginning to reopen. Sentiment is high, and there's a lot of indicators that kind of fall into that Beige Book, which I will not go into now. But there's a lot of things that go into what that Beige Book index is, and they're tracking very positive. The other thing too on the right-hand side, which I thought was particularly interesting, is this is essentially mentions of slow, the word slow or the word coronavirus or COVID in some of the surveys that are coming back. And so there's data that comes back from all the Federal Reserve districts, and there's also a narrative that says this is what's going on in our district. This is what businesses are saying are impacting their business opportunities and things like that. And as you can imagine, as we look last year, there was a lot of mentions of slowing and coronavirus and COVID impact, and a lot of basically kind of these negative words, if you will, kind of indicating businesses are slowing down. But the fact is, if you go from left to right, you can see the incidence of those words being mentioned has gone down. So that kind of tells you that businesses are becoming inherently more positive because they're not talking about coronavirus as much as they were, and they're not talking about slowing conditions as much as they were. We've got several different things on this slide, and it all relates to retail sales. And this is a data point that has looked really strong in the last week. We knew it was going to be strong, and it was strong. And so I'll just kind of start in the upper left here. And this is a retail sales year over year. You can see that uptick, very strong uptick. And you can see the blue, light blue bars, which represent all of the stimulus money that's being spent and circulated in the economy. Very positive from a retail sales standpoint. So that data looks really good. Now, if you go down to the bottom left, you can see in that dotted line what this recovery looks like in retail sales. And you compare it against what happened in 2008, 2009 during the Great Recession. And you can see, 12 years ago, it took us a while to kind of recover. I mean, essentially, a couple of years. Whereas here in the last in this last episode, it's recovered actually very, very quickly. And then if you transition over to the right, you can see the components of that. The last data point in March for retail sales was 9.8%. That's a huge number. And even within core retail, it was almost 7%. But you can see what's driving that. It's sports, hobbies, books, music, clothing, motor vehicles. So we know that motor vehicle, at least used car sales, are really high right now. Prices are really through the roof. Food services, building materials, gasoline, and electronics and appliance stores. These are all areas that are contributing to a much greater extent to this resurgence in retail. And obviously clothing and accessories has been an area that's been really impacted, but it's picking up. And you see sports and hobbies, that's really picked up. And that's a symptom of this economy reopening in a big way. And obviously the desire for more mobility is driving motor vehicle sales, and then food services, as you can imagine, again, impacted positively from a reopening economy. Now we'll talk about inflation here for a second. So we've got lots of little data points here as well. So on the left-hand side gives you two flavors of CPI, the Consumer Price Index. This is what is reported in the newspapers and in the financial press. It's not necessarily what the Fed looks at in terms of their definition of inflation, but it's a really good proxy. So on the one hand, if you look in the upper left, you can see the year-over-year Consumer Price Index, the all-in CPI. Is up 2.6. So we knew that inflation was going to pick up in this last data point. Now, if you subtract out food and energy, which is what they call the core CPI, that's below that. That number was actually a lot lower, 1.6%. So food and energy tend to be really volatile. And if you strip that out, you get to what is kind of generally assumed to be kind of a more normalized rate of inflation. And then, if you take it on its face, it's obviously not rising as much as the overall CPI is, but more importantly, it still remains below that Federal Reserve target of 2%. And it doesn't look like from the trend line here that it's necessarily going to get there anytime soon, but we do expect it to pick up. Now, if you transition over to the right, the chart that has all the color in it, this is kind of why we think, and there's some other things that kind of backfill this in the next few slides. But we do have, inflation food and energy does matter to all of us in terms of inflation. But you can see the headline CPI is beginning to trend up. We expect it to continue to spike because of energy going up. And then any of you that have had to fill up your gas tank lately know that the gasoline prices are going up. But we also have a contribution from food costs that are moving up too. And so those two things coupled with this, the core, basically everything else within the CPI, leads us to think that we're going to have a pretty strong inflation number here, probably heading into the summer. And then it tempers off a little bit, but it's like we've been telling you in Charts of the Week and the market minutes over the last several weeks, that we expect the inflation rate to be higher than it has been. Here's a chart that kind of breaks up commodity and service inflation, and this is basically within the core CPI or the consumer price index that we were just talking about. If you look at commodity prices that make up that make up that part of the CPI, you can see those prices have gone up, and we've been talking about this for weeks. Lumber, we've looked at corn prices, we looked at steel prices. We've looked at a lot of different commodity price impacts that are moving higher, and that's clearly in evidence here in the red line. Now, if you look at the blue line, which is core services, which frankly makes up a much bigger part of our overall economy, you see that those have been pretty tepid lately. And as you might imagine, when you shut down an economy and you're struggling to kind of reopen, your services inflation is going to be less. In fact, not quite disinflation, but certainly less inflation. And that's obviously in evidence here as well. But in the last reading, you can see that blue line tick up just barely on the right-hand side as this red line continues to move higher. And I think that is going to help provide feedstock for this little burst of inflation that we expect. And if you look at the fund manager survey, if you look at the investor landscape and you try to take stock of what investors are thinking, well, clearly they're looking at this in the same way that we are here today. And their inflation expectations are at all-time highs right now. You see a lot of people moving into inflation protection type devices and guarding against the risk of inflation. You see rotation into more cyclical areas that would tend to benefit from inflation. You're actually even seeing exchange traded funds being created to try to take advantage of this thought right here that inflation is going to pick up. Here's an Institute for Supply Management Production Index with manufacturing output. And then I've got a chart on iron ore prices. And, I kind of throw this out here because this is the production side of it. And I just want to continue to emphasize that costs within the production channel are continuing to move higher. And you can see that in iron ore. And obviously, iron ore is an input into steel production. And then on the left-hand side, you've got output that's moving up, but you've got prices that are coming along with it. And so, you have to take both of these in isolation. And while it's good that we see manufacturing really picking up in areas, and again, we do have supply chain choke points that are very notable that are going to take some time to work themselves out. But it is good to see output and all of the manufacturing indices move higher. But just know that with that is coming additional inflation within the production channel that at some point will begin to get passed along to the end user, end consumer. Motor vehicle assemblies. Now, this is a manifestation of the supply chain issue that we've had. So we know that we have had a major disruption in semiconductor production. This is a classic case of where the economy opened up a lot faster and more robustly than anybody ever thought. And so as a result, manufacturing of components and semiconductors is really struggling to keep up, notwithstanding the fact that many producers in the South had to curtail operations during the winter storm here a couple of months ago. But you can see motor vehicle production is down. So this is an area that, that chart's going to look ugly here for a little while until, the supply chain issues kind of work themselves out. Here's a brief chart on the energy sector, and more specifically crude oil and gasoline. And you can see, an interesting development here. So as we've had more usage and more gasoline sales and things like that, days of supply have actually gone down. And that's obviously a manifestation of an improving economy, more healthy economy. You see that also on the gasoline side, which in turn is one reason why you're seeing higher gasoline prices. And so again, supply and demand, if you look at this chart in total, it makes you probably feel good about the sustainability of crude prices at current levels. which is good for producers. It's good for the sector, good for the credit markets for all of the high yield and junk bond issuers in the energy sector. That you can begin to reopen wells, you can begin to increase production again because it's more economical to do so. Here's another data chart that we're going to have to follow. Again, this is a CPI or Consumer Price Index input, and this is a rent of a primary residence. And we know that during COVID, there was a massive flight from the cities, if you will, with all the shutdowns and what happened, and a lot of, well, suffice it to say that rents went down. You can see that very clearly here, and they continue to remain weak. So, and when you think about owner's equivalent rent in the CPI index, this would be something, that would actually be an offset. So today I've kind of offered some components of inflation that we know are going up, and this is a component of inflation that is actually not going up. So you have offsets. And so that's why, even though we expect inflation to go up, we don't expect it to go up so much that it becomes untenable, that we overheat, that it creates this negative shock for the investment markets. And owner's equivalent rent and this rent of primary residence that you see here is a component of that thought. Here's another data point. This represents import prices, and this is an index which actually excludes petroleum. But if you think about all of the other things that we import, this basket is actually going up in price as trade has kind of begun to pick up, and we see the changes in the Baltic Dry Index, and we know that shipping is picking up, and even with some of the choke points that we had recently with the Suez Canal and ports being clogged up, we know that there's just overall more activity out there. And what we can see here is the import prices are moving higher, clearly. Quick look at state tax revenues. A lot has been made of the follow-on stimulus package, and there's a lot of aid that is earmarked, if you will, for state and local governments. And you can see here from the state standpoint, in that kind of that gray dotted line, that states really bounced back pretty well. I mean, it was a pretty bleak situation, and I'll be on record as having said last summer that this could be a really ugly and potentially catastrophic situation for a lot of municipalities. But oddly enough, we, with the reopening in this economy and the better than expected economic performance, that we averted what could have been disaster for some municipalities. And in fact, state tax revenues have actually looked pretty good. And in these charts of the week, I've actually argued when this stimulus bill was being being articulated in Washington, that I'm not so sure that we needed a lot of aid for state and local governments because of what you see here, the fact that they're above where they were a year ago and they've recovered very nicely. This is something, just a quick comment on a small business, and I've got several kind of tangential things to show you about small business that are actually very encouraging. Again, this is another area that I was really worried about several months ago, and I'm cautiously optimistic, but I'm guardedly optimistic as well about the status of small business. Here you see, the share of small businesses that are planning either raising prices or planning to raise prices, which means they're in a competitive enough situation that they're in position to be able to raise prices, which is a very positive thing. And to have small businesses be able to raise prices in an environment makes us, makes me feel like the competitive landscape and the overall landscape for small businesses is improving consistently here. As we continue along the path of talking about small businesses, here's a couple of more data points that I think are very positive as well. Again, in the last slide, we saw that there's pricing power that's coming back into small business. Here, that what we're finding, and this is actually very consistent across the entire labor landscape, that they're basically positions that are hard to fill, that kind of lead us to believe that there's actually a labor shortage right now as we struggle to, get back and reopen the economy. So there are openings that are hard to fill. That index is really high, while at the same time, as you might imagine, if you're in kind of a tight labor situation, that compensation and wages are moving higher as well. You can clearly see that taking place on the right-hand side. High propensity business applications. This is again, more food for thought here on the small business sector, but we've had a lot of new business formation, and this represents the entire gamut. This is like business, whether it's corporations, LLCs, sole proprietorships. This is business applications that are really going through the roof, and a lot of people are creating second businesses from home. There's a lot of younger folks that are getting involved in what we call this gig economy, where they're doing different things simultaneously to try to establish themselves in the economic world here. But business formation is up, so another positive data point. Quick note on housing. As we've been watching this for a while, we know that the home builder optimism index is really high. We know there's a housing shortage, a housing stock shortage across many major markets in the U.S. But here we can see, and this is actually a good thing for buyers, if you will, that you've got on the right-hand side, the 30-year fixed rate is actually moving back down after having spiked here earlier this year. A lot of that has to do with the fact that the 10-year Treasury has, in many respects, stopped moving higher and stopped accelerating from where it was at the end of last year. But then also what's interesting here is at a time where you've had kind of a renewed, maybe a little shot in the arm as far as affordability goes for buyers. Even if home prices are moving higher, rates are moving lower, but at the same time, refinancings are actually moving a little bit lower as well. So this is interesting. I have to wait and see. We know that banks are beginning to tighten up just a little bit on standards, not wanting to dilute portfolios, but again, not anything that I would necessarily be very worried about right now. But it may be simply a symptom that a lot of folks that were able to refinance have already done so, and then now you're kind of reaching down into some of those more difficult credit layers where people may have a harder time getting refinanced. Let's talk about the equity markets for a little bit. There's some interesting data, interesting charts out this week that I thought were interesting to share. This one in particular shows the U.S. Market relative to the developed market index for equities. So this is basically a chart with this line that's moving continually higher. It just shows you that on a relative basis, the U.S. market is so much stronger than international developed markets are right now, which in turn would argue for increased diversification into international. I still think that there's staying power and there's more room for upside in the domestic market, but there's clearly more value in some of these foreign markets. A quick chart coming to us from Bank of America in their Global Fund Manager Survey that only 7% of investors think we're in a bubble. And that's, this is, kind of along the lines of what we've been describing over the last, really the last month or so. It's just this effusive enthusiasm in the market right now. It's really uncanny, and volatility is exceptionally low right now. There's a lot of enthusiasm over earnings, and we've got a chart on that. A lot of enthusiasm over the fact that we've got these increased money flows. We've got a lot of money flows coming into the market. We've actually got a chart on that. But here is really the kind of the end all be all for sentiment, and that that there's very low levels of pessimism in the market right now. Here's a quick chart on the kind of progression of returns for the S&P 500 entering an earnings season. So let's be clear about what this represents. This is like basically what happens to market returns for a period of time as you head into earnings season for the particular quarters. And right now we are really on the front end of all of the first quarter earnings reports for the S&P 500. And we've had a reasonably meaningful move at this last one. So there's a lot of optimism. There's a lot of expectation that's already priced into the market. Obviously, companies are going to have to fulfill those expectations, or we're going to see a reasonable amount of near-term volatility. So we've had earning estimates that have moved higher all during the last several months, and so there's just a lot of optimism built into the investment landscape here for U.S. equities right now. Here's a slide that I think does a really good job of reinforcing this thought of we've been talking about the enthusiasm and the euphoria to some extent that's being built into the markets right now. And this is the notion of equity risk premium. And so when the equity risk premium is low, the market is very enthusiastic. Fear factors are low, enthusiasm is high, and that's where we are right now. And what this index represents is essentially the earnings yield for the S&P 500 index less the 10-year Treasury yield. That's what they call the equity risk premium. And so essentially to calculate the earnings yield, you just take the sum of all the earnings of the S&P 500 and divide it by the price to get an earnings yield, and then you subtract out the 10-year Treasury, and that number is really low. And so, we saw, we saw this level back a few years ago, and the markets during that period of time were reasonably good. But these are pretty low, pretty euphoric levels in the market right now. Here's another reference to what I mentioned earlier about fund flows. And so you see a lot of momentum coming into the market. On the right-hand side, you've got equity exchange traded fund inflows. And these are equity ETFs, not just overall ETFs. And you see that number really spiking. There's a lot of liquidity in the market that's coming into the market and trying to find a home, trying to, as they say, deploy capital in the highest and best manner. And so that's finding its way into the equity markets. And then on the left-hand side, you can see that this movement in the market is actually being driven by these more cyclical areas, at least this year. Now, last year we obviously had a lot of movement in technology stocks, and really the FANG stocks, kind of the small handful of stocks that were driving the boat last year. But that regime has shifted, and now you can see energy. Financial resources, i.e. banks, basic resources, and still technology is in there, but we see other areas beginning to contribute. And these are areas that tend to react better when you're on a cyclical upswing, which is where we are now. So two things here, obviously a lot of fund flows that are coming into the market, but these fund flows are migrating to more cyclical areas of the market. Well, here in our last chart of the charts of the week pack for this week, we have the funded status of corporate pensions in the U.S. over the last decade, and this kind of brings us current. And so this is one of the interesting developments that hasn't been receiving a lot of press lately, but I find it to be entirely positive, is when you have a really strong move in equity markets, you tend to have a rebound in these funded status levels for pensions. And so there are a lot of pensions out there that have, relatively low funded status, which means that, to pay their beneficiaries down the road, these are defined benefit pension plans that are providing a fixed benefit to retirees. And so when you have poor equity markets or you have poorly managed pensions, you have a funded status that's really low. And so there's a bigger risk that you're not going to be able to meet the obligations to your pensioners. But when you have strong equity markets like we've had, you have the situation that you can see here very clearly, is that we've really had a spike in the funded status of corporate pensions, which is a really good thing, because it de-risks what the government might have to step in and provide from the Pension Benefit Guaranty Corporation. If pensions go bad, that's a federal fund that is set up when pensions do go belly up. But right here, it tells you that there's a higher degree of confidence in the status of these pensions that won't happen. So it's a byproduct of a strong economy, byproduct of a strong investment market in particular, but a really good takeaway here for this week. Well, that will do it for Charts of the Week this week. I hope you've enjoyed the presentation today. The information on your screen is how you can reach me if you have any questions or comments. I would love to hear from you. Hope you have a wonderful week, a safe week, a productive week, and we will see you again soon.